All right. Good morning and afternoon, everybody. My name is Alan Taylor from Maxio. I'm joined here with Randall Lucas from SaaS Capital, and
Greetings.
we're here today to talk about operating in the new normal. So, what does that mean? That means that we are seeing a trend back to historical averages when it comes to SaaS valuation multiples, back from the craziness that we saw from 2021 to 2024. Randall will take you through the SaaS Capital Index, which goes through these valuation multiples on several different vectors. We'll talk a little bit as well about how the rich are getting richer, especially in this AI boom that we're seeing today. And then finally, we'll round things out with a little data on investors and their thoughts on what is driving premium versus distressed valuations in this current market. So really eager to share some of this great data with you all, proprietary data that's helped us truly understand what investors are thinking and how software companies are being valued. From my standpoint, I am seeing valuation multiples that are much more in line with what we saw pre-COVID, 2016, 2018, while we were still in zero interest. However, now we're at a point where we've come back from COVID, we've come back from the dip following COVID, and things are looking a little bit more back to normal. Randall, I will hand it to you to share a little bit more about SaaS Capital as well as the results.
Thanks, Alan. Hi, I'm Randall Lucas with SaaS Capital, coming to you from just outside Boston. Good afternoon. SaaS Capital is a specialty lender. We lend to growing private B2B SaaS companies with 3 million and up in annualized recurring revenue. We lend amounts of 2 to 12 million. And as a result, we are focused on a population, those small, typically single to double digit million ARR SaaS companies, that is really concerned about valuations and what they're going to get as a price for their company or as a valuation when they raise money. So we spend a ton of time thinking about this. And something that we've done over the past, at this point, almost 20 years, is we have curated something called the SaaS Capital Index. The SaaS Capital Index is our view of the universe of publicly traded B2B SaaS companies. So we go through every IPO and every go private or M&A transaction that takes somebody off, and we update this list. We include only those we view as relatively pure B2B SaaS plays to ensure that it's meaningful of specifically this industry. So we exclude VoIP providers or storage providers or colo or hosting providers. And what that's given us is a relatively stable population of companies over time that share the same characteristics that we can derive meaningful data from. So going back to 2008, on this population of companies in the SaaS Capital Index, we have compiled and tracked their market capitalizations as a proxy for their value, their annualized recurring revenue run rate, and a number of other metrics. But the most important thing, or the most heavily used part of the SCI, is the valuation, which is their valuation as a multiple of their annualized recurring revenue. So we have tracked that historically, and obviously with anywhere from 40 to 100 members of the index, we need to summarize that. And the way that we historically have done that is by taking the median at each month of the valuations that we've observed. So although that there will not be a test on all the components going into it, the thing to know here is that when we talk about the SCI as a shorthand, we say the SCI is sitting at 6.0x as of September 30th. That means that on September 30th of this year, the median valuation multiple in the SaaS Capital Index was 6 times annualized recurring revenue. And we've tracked that over time. You can see here on this graph, this has been in a range that has been as low as 2x at the median and as high as 16 or 17x at the median. But historically has kind of been in this band in the middle, you can see, where it's been somewhere from 6 to 10x. Okay, so you can think of us as being, and this is tough for those of us who maybe had some expectations set around 2021 of what valuations might be. But although it feels a lot lower than it was 4 years ago, we're actually back in a range that's fairly normal. So one last note on the SCI before we move on. If you have an interest in the SaaS Capital Index, we publish it as a free service to the industry. You can find it at saas-capital.com, and you can sign up and we'll send it to you each month as it's updated. But we decided to pry this apart a little bit and learn a little bit more about it. Specifically, we looked back at over time, and we identified a time period that we called the old normal, broadly speaking, and that's the tan banded section here from roughly 2014 to 2020. And during the old normal time, we feel that that was a time when investors had recognized the SaaS business model and the characteristics of it, and were treating it rationally. Prior to that, SaaS was a great bargain. Investors didn't value it enough. Arguably, you should have plowed as much money as you could have into SaaS stocks back in 2012. Okay, you would have done very well. But 2014 to 2020 was, roughly speaking, the old normal writ large. And I'd like to focus us on the period of 2016 to 2018, which we call the low old normal. And the reason for that is that that was a 2-year period that SaaS median valuations stayed in a range of about 6x to 8x ARR. And that maps very closely to what we've seen over the last 2 years. In the light blue band at the side of the screen, you'll see for the last couple of years, we've kind of been in that same range of 6 to 8x ARR as the median valuation multiple. So at first glance, today is a lot like the old normal of 2016 to 2018. And there's good reason to think, it's been pretty stable for a similar period of time. It makes sense at a surface level. But as often is the case with things that are sort of a surface level observation, there's some more nuance or devil in the details. So what we did is we went back, and because we had all that data, not just for the median, but for all of the components of the SCI at each point in time, we graphed out the spread or the distribution of components, of valuations observed in the components of the SCI. And so a way to think about this is maybe to think back to your stats 101. Median is like if you have all the children in the class line up in order of height, and you count, and the kid in the middle, however tall they are, that's the median, right? That may or may not be the same as the average, which is if you add up all the heights and you have a 7-foot tall kid on one side, your average is going to be much higher. Mm-hmm. But that's how you do the median. But you might have a very different picture if you look at, the kid in the middle is 5 feet tall. Is the kid at the 25th percentile? Is he 4 feet tall, or is he 3 feet tall? The kid at the 75th percentile, is he 6 feet tall, or is he 10 feet tall, right? It's a very different picture. So this is essentially doing the same thing to those valuations. And if you look in that low old normal band from 2016 to 2018, you see what I would characterize as a pretty tight distribution. So 6 to 8x is the range, and the highs and lows, the leaders and the laggards in there, kind of stayed within 5.5x to 9.5x. Okay, so you didn't see a huge spread in that. It was kind of SaaS is a known thing. Here's what it's valued as. The good SaaS companies get a little more. The less good SaaS companies get a little less, but it stays pretty consistent there.
Yeah, Randall, one thing that's interesting here is this does jive pretty well with my experience in private markets. So a bit more of an introduction. I've done a lot of corporate development in my career, leading add-on acquisitions, typically in the range of, call it 0 to 30 million in revenue. So pretty similar to the SaaS Capital portfolio size as well. And this jives with my lived experience, right? I would say from 2016 to 2019, virtually everything I looked at was in the 3 to 6x ARR range. You do a little bit of handicapping for private markets and strategic acquirers. But, what I'm seeing over the past couple of years, again, both my experience and peers, the ranges are really broad. I've seen some deals go for as low as 1 to 2x. And I've seen several that go well beyond, 10, 20x plus, especially as companies are getting into new markets. And Randall, I'd be curious to hear what you're seeing in both public and private markets and what you think might be contributing to this greater spread.
Yeah, so good question there, and quite an opposite observation. SaaS companies may have appeared to be similar enough back in the day that they could be assessed in a similar way. SaaS companies today, at least by the numbers, what the numbers are telling us is that they are viewed and valued very differently, even if in the median or the average they seem the same. So this blue period that shows our new normal shows public markets. So to answer the public markets part of your question, the spread between those lines has spread out quite a lot.
Hmm.
And now it's still sort of a 6 to 8x average, but the leaders and the laggards are now 4x and 10x, as opposed to where they might have been 5x and 9x or 5.5 times and 9.5 times before.
Hmm.
The other one I'll point out, not quite as dramatic as your observation of a 10x or 20x multiple, but the 95th percentile, or sorry, I guess I've got the 90th percentile graphed out here,
Hmm.
is yet higher. It used to be that the 90th was a little bit higher than the 75th percentile. So your leaders were the 75th percentile, and then your super leaders were the top 10%. They were a little bit more. The top 10% are valued significantly more, 5x ARR more, okay, than your 75th percentile now. So the spread is bigger. I'd say that for private markets, we see some similar, quite similar results, and I'll get to that in just a moment. I would like to share a couple of other numeric pieces for you here. These ones are going to be a little bit of an eye chart, so I apologize. You don't have to get out your stats 201 textbook for this, but I'll just briefly touch on what these graphs mean. And I think rather than focusing on the details of the math behind it, you can kind of visually see that this is not the result of a spike or a momentary or transitory market condition. This is a relatively stable effect that's been in place for a couple years now, and is quite different from the supposedly similar 2 year period that we call that low old normal. So this one here, your blue line is once again your median. The green line is going to be what they call the interquartile distance. It's the number of turns between your leaders and your laggards. So if your leaders are getting 6x and your laggards are getting 3x, then you'd have that green line would be at a 3. And that's
Hmm.
kind of where we were in 2016, 2018. Today, it looks more like the difference between the leaders and the laggards is 6 turns of revenue, right? So that's big, especially if your median is only 6 or 7x. The leaders and the laggards are much further apart. So just another view on that. And then finally, the extra credit version of this is looking at the skew. And again, let's not get into the details of this other than to maybe remember that you've got your bell curve. Okay, if the bell curve is perfectly even, there's no skew. If it loops one way or another way, we call it skew, and you can measure that mathematically, positive or negative. It's not important what the exact number is. What is important is that for most all of the history of SaaS, this was negatively to 0 to negatively skewed. So it was kind of more like a bell curve that was more or less even, maybe a little shifted one way. Ever since our sort of return to a new normal post COVID, 2023 and onwards, it's consistently been a positive skew. So it's been a very different mathematical shape of the curve of what's going on. Okay, so if we drew that bell curve, it would have a distinctly different shape than an unskewed bell curve did historically. So getting to a little bit more of your question about private markets and what we see inside the SaaS Capital portfolio. And again, we're lending to companies with 3 million up to, practically speaking, perhaps 30 or 40 million in ARR. And what we see is there are still great deals getting done. There are still M&As occurring, and there are ones going out at 8 to 10x multiples. So we've seen that happening in 2024 and 2025. However, great deals have to have some great characteristics, and that's what we're seeing, is that is either great numbers, so you've got the KPIs both always around some growth and usually also around profitability or potential profitability, or it's going to be a strategic auction type process. You've got something that's strategically important to a buyer and they need to snatch it up before some other strategic does. Those characteristics and those dynamics are still driving great valuation multiple outcomes, and maybe that's what we see in the kind of skewing of the curve, where the high performers are higher. But the flip side to that is that a merely okay deal
Hmm.
is getting lowball valuation or is getting no bid. And we've seen broken processes, and we've seen folks go out to market and come back and decide, no, we're going to keep growing for another couple of years. So hopefully that answers the question. And a way to sum this up might be the rich are getting richer. And so with that, I wonder if Alan, you'd like to maybe take us through some of what you've been learning and discussing with practitioners and investors on the equity side.
Yeah, of course. So everything that Randall has been saying, it makes perfect sense right now, right? Okay deals are not going to get a ton of attention. Great deals are going to get that premium valuation. But what is really defining those okay versus great metrics? I think we all know we have our standard metrics that we look at from a revenue growth, ARR growth, EBITDA margin standpoint. Everybody knows the rule of 40 is becoming the rule of 50. We're all seeking a combination of either growth and profitability or growth with limitless potential. And, not all of us have that. So what I went to do is I went and spoke to some investors in private equity, venture capital, and corporate development. So a broad mix of, investment types, but specifically those that invest in B2B SaaS businesses that are sub 100 million. So truly in this range of, call it private company valuations. I asked them, what's your rule of thumb around some of the key metrics that often come up as a influencer, but maybe not necessarily the number one driver or constant in any sort of valuation multiple, right? So GRR, NRR, and LTV to CAC. I know we're all very focused on those when it comes to positioning our business and the long-term growth and durability of them. And we know investors like them, but what is good? So we went into that and asked for each of these three metrics. And first, we'll talk about gross retention. So of the respondents in the lower bounds, they effectively said about 85% is kind of the low end of gross retention for deals they'll evaluate. And then for the upper bound, virtually everybody said about 95%. Some interesting quotes I had are really that some investors see that there is no upper bound, right? They view anything in below a certain threshold as not mission critical, not a market leader, or not serving medium to large enterprise. I also know GRR is a huge, factor in looking at downside protection for investments, right? A lot easier to recover from a low bookings year if you have 95% gross retention. So investors and lenders alike love to see high GRR. This also jives with my experience. Oh, sorry,
Alan,
go ahead, Randall.
yeah, Alan, I wonder, can you just kind of recap maybe how the question was posed? So you asked the VCs, is this for what they're seeing, or is this their portfolio, or is this what you would even consider as to kind of take a meeting?
Yeah, no, of course. Thank you for that, Randall. The way that we framed the question was on the low end, right? What is the threshold that you start to hit where you either begin handicapping valuation or even figuring, hey, I might want to walk away from this deal, right? And then on the high end, what is a number that suddenly gives you stars in your eyes? What gets you excited? What gets you ready to open up the wallet and say, I am willing to pay beyond, what we typically would for this.
I get it. So it looks like the most common answer was that something around 85% GRR. If you're below that, you're getting dinged. If you're above that, you might get a bump to the valuation. That's the idea.
100%. Well said, and much better framed than I put it. But yes, investors are expecting you to be in that kind of 85 to 95% GRR range. And if you are knocking on the door of 95% plus, you would be doing yourself a great favor of shining a spotlight on that and continuing to drive that as a key metric for your business going forward. Next up is the next side of that is how are investors viewing net revenue retention? And similarly, it was really, nice to see a lot of consistency in the answers. We saw a lot of clustering right at 100% on that low end. And then for the upper bounds, everybody was kind of between 110 and 120% roughly. So investors are expecting, call it 100 to 115% NRR. Reasons, why they are viewing this as a strong valuation driver. One investor that was specifically looking at lower mid-market companies said that it shows expansion efficiency, right? There's one-to-one impact without customer acquisition spend. Now, that can be true, especially in cases where your net retention is growing without any active cross-sell efforts. And, but it is a pretty good heuristic to say if there's high net retention, there's probably low customer acquisition cost. On the flip side, a lot of investors also said that if it's below 100, that's a red flag, right? It signals a major issue or an event. It signals that you are not able to sustain and grow with just your existing customer base. And it highlights that you absolutely always need to be grabbing new logos to continue to grow your business. So thinking on the flip side of gross retention, high gross retention, providing that downside, protection, low net retention suggests much, much bigger downside risk, as it shows that you need to go beyond the pond that you're already fishing in order to grow.
Yeah.
Yeah. And Randall, I know lenders, love gross retention as well as net retention. How are you and your portfolio being these two metrics as a, driver of either investment decisions or, hardiness of the companies you're working with?
Yeah, good question. So I'd say that we've seen a few things. One item I'll mention, and for those of you who maybe been on these webinars in the past, we did one where we talked about retention specifically in some of the data, where we uncovered that the average gap from gross to net is 12%. And it's actually pretty nice to see that, in fact, the answers from the VCs seem to be that they also are expecting and observing about a 12% gross to net gap. In the world of SaaS Capital, we're working in many cases with folks who are in the 3 to 10 million revenue run rate range and are growing at a double digit percentage, but are not at that time going to be in the market for venture capital, right? They're not going to be growing at the rate that it's time for rocket fuel. And that's part of the role we play in the ecosystem. We help folks boost their growth so that they can either get into that range or avoid having to sell equity. Or in some cases, we let them kind of go to market and raise capital with a backup plan or a bargaining position that allows them not to be reliant on what the bid is from the equity folks. So as a result, we're a little more, I'd say, big tent in terms of we will work with folks who don't have the premium retention metrics that might be required for a venture capital raise. That said, these are roughly in line. I think we're not in the business of assigning a valuation when we do a loan. So we don't have that same concern of saying like, oh, if your NRR is below 97.5%, we're going to lower the pre-money. But I would say that these numbers jibe roughly with what we're looking at. Folks with less than a 90% net revenue retention are probably not going to be great candidates for external financing today. There are exceptions. This I would assume more of an enterprisey sort of population. Are you talking about here? Is that a fair assumption, Alan?
I would say so. Yeah. Most of the investors said kind of centered around about 50 million is our average revenue target.
Yeah. I mean, and when we're working with folks who maybe sell to SMBs, okay, you're going to have a GRR problem trying to get 90-95% gross revenue retention selling into a market where, there's not a 90% survival rate among small businesses, right? So it's very difficult. It might be great to hit an 80% gross revenue retention, but you had better hope that you've got at least that kind of 12-point gross to net gap and you're in the 90s for net. That's what I'd say from our perspective.
That's a really good point. Thinking through some of the other quotes that we had from investors in this, it really did call out that especially when you're in that sub 10 million range, people are going to view GRR and NRR in very different ways, right? If you're dealing with a company that has a very low customer count, for example, right, you're going to have to understand that you are going to see big swings in those metrics. So they're a little bit less predictable for understanding what the quote unquote flow business truly is. However, I did see some investors, especially on the seed side. It was very interesting. One of them said at the seed range that, hey, it's not meaningful enough to truly understand. I'm looking at product market fit and growth potential. At this point, I can't tell you too much based on GR and NRR. And I get that. I've definitely seen in my career some, I would say, early stage acquisition targets that had less than stellar retention profiles. But then when you start to dig into under the covers a little bit, you'll see, maybe they lost 2 out of their 9 customers in a year, right? Or maybe it was one large customer or one-off event. So there's definitely a lot more nuance the lower in the market you go. But in some ways, oftentimes it's a higher bar. One of the other person in that sub $10 million range that responded with some comments actually shared they look for 100% gross retention for early stage companies. And honestly, that is probably a pretty good heuristic for both understanding product market fit as well as founder discipline and how they're growing the business. So I can see, especially in that lower end, it's going to be much, 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 much more in context of the business and the business model that they're trying to grow from.
Yeah, you don't get to rely on the law of large numbers there. Your denominator is going to play a pretty big role. I would say, You've also got the problem with if you're doing, say, an enterprisey type sale and you've got a 3-year contract and you're a year and a half in, your gross revenue retention is probably not a super meaningful number.
Exactly. That's a really good point. And that is something that investors do look at, it is retention rate in relation to renewal rate, because that can often uncover some risk. Just stopping quickly to answer a question here saying, do investors in the market today view GRR as churn only or fully burdened, including downsells? In my experience in working very closely with private equity funds, they are truly looking at understanding churn plus downsells. They're very simply trying to answer the question, if I have $100 on January 1 of this year, what is that $100 going to look like on January 1 of next year? They're truly understanding that revenue component. So, there is importance in understanding the full churn versus contraction. And I'll speak about that a little bit more on a future slide. But from an investor standpoint, revenue retention is revenue retention. They're trying to understand what is coming in or going out the door.
Although I have seen there was an IPO that shall remain unnamed, although haven't been that many recently. But since our last talk, Alan, there was an IPO that published some shockingly good gross revenue retention figures for their SMB clientele. And when we dug into them a little bit, we discovered, as the questioner pointed out, that they were not accounting for downsells. They were only accounting for complete churn. And otherwise they gave you full credit for retention of the customer, which, if it's truly gross revenue retention, I don't think that makes sense. And as a lender, I would never, while I might add logo churn as something I looked at and was curious about, it's not a replacement for GRR.
No, it's a really good point. I would say there are even a couple of investors that did specifically call out in their comments to say, I define gross retention as churn plus contraction. And it's a very, very, very common thing to see on the buy side of people selling a retention metric that is maybe not the way that you would define it, and maybe includes quite a bit of carve outs. So when you're evaluating public companies, definitely spend time in that non-GAAP metrics definition section. And if you're dealing with private companies, my advice is always look at the real data, right? Look at the actual revenue recognition data and impute it on your own to truly.
What do we call the specific report that comes if they're running Maxio? I see it.
That's right. That's the subscription momentum report. Yeah,
that's the one.
Yep, exactly. Investors want to see that subscription momentum, revenue roll, ARR snowball. Pick your term. There are several out there. But that concept of the snowball of recurring revenue and understanding how you disambiguate that is so critical for investors to understand your revenue profile and your growth pathways. Flipping the P&L and starting to look more on the cost side, let's talk about LTV to CAC. And this is what I got. On the lower bound, I got a bunch of scribbles, and on the upper bound, it's all over the map. And this was a little bit of a red herring question because I had a feeling I was going to get this answer. And the answer was all over the board. We had some answers, that gave pretty broad ranges, some really tight ranges, some not even answering the question at all from a number standpoint. And I had a lot of quotes here saying there's a lot of nuance in the upper and low bounds. Bootstrapped companies are, potentially underinvesting in go-to-market, right? You might see a really, really low CAC, but in reality, that could be that they're under optimized. Maybe their CAC should be a little bit higher to drive a little bit more growth. Also, it's fine to have a land grab strategy, right? So if that is your strategy, of course, you're going to have a high CAC, and investors know that. Some of the other comments were just more focused on how are you truly defining that metric? And especially as you're taking things as complex as starting to include bookings into your metric, right? Everybody knows that bookings can be defined quite creatively by several companies. And a booking is not a booking from company to company, right? And because of that, and also because of P&L categorization, where are you including account managers? Is that in recurring COGS or is it in sales and marketing? Depends how much they're selling versus not selling. How are you making that judgment? Are you carving out a portion of it? And what we're seeing is people trying to simplify a little bit more, right? Focusing on things like the SaaS magic number, focusing on things like gross retention. But ultimately, what they're going to be looking for with LTV to CAC, it's not necessarily a certain benchmark that they have to hit. It's more of a heuristic to better understand, can this business profitably scale into the future? And I like to consider this one of those metrics that you dig into, especially when things, as I would say, an interim health check, and especially if things are not looking right, right? This is a good next level metric for investors to get into. But Randall, I'd love to hear kind of your thoughts on LTV to CAC and just kind of measuring sales efficiency generally and how you think about
For
this.
in our world,
Yep.
we just don't meaningfully track LTV CAC. It's so diverse as to how folks go to market. I mean, in our population and the lenders, excuse me, the borrowers that we're lending to, it could mean a lot of different things. And so from one to another, it doesn't make a lot of sense to compare deal to deal. If we're monitoring, over time, we might ask a company, or if it's a metric that they present a certain when we do a quarterly update, and that's trending upward, that's great. Is it because customer acquisition cost is going down or LTV is going up? It's good to know, but it's not commensurable. I think the exception would really be if you were talking to a vertical investor who was really focused on a particular vertical where these are maybe a little more well defined, and it's people have a similar go to market strategy and a similar kind of target set. Probably makes more sense. But if you're dealing with both vertical and horizontal solutions that sell to different sizes of customers with different go to market approaches, it's very tough, I think, to see LTV CAC in a vacuum and say, oh, that's a good one or that's a bad one.
Yep, exactly. And you think about things like with a PLG based company or a company that's doing both PLG and SLG. How do you measure that, right? Are you taking the sales cost and applying that to the revenue that you're capturing through the self sign up channel? Are you taking self sign up channel costs and tying that to the sales channel costs? It really does need to be a channel by channel, segment by segment, product by product approach, just depending on how your business is organized.
Alan, do you think there's a revenue run rate at which it's the point at which you start using LTV CAC? Because something else I saw in my early stage days is you'd have these kind of 0, 1, 2, $3 million revenue companies, all the way up to maybe up to 10 in some cases, where you've got effectively founder led, CEO led sales. And how are you really counting your customer acquisition cost if there's the founder is out there selling, right? You can't go hire a second founder CEO. It doesn't scale, right?
Absolutely. And I think my answer to that is going to be a little bit less about a magic number saying it's 10 million or 20 million or whatever that is. And it's more, do you have a mature sales motion? Do you actually have a true sales and marketing team on the P&L? Because if you don't have those actual teams, like Randall's getting at, there's a lot of opportunity for funny business. I'm a founder. I'm a founder. I'm CEO. I'm G&A. Don't mind that I'm doing all the selling, right? Don't mind that I have a couple of BDRs and a marketing team supporting me and I'm the one closing deals. And that's where, the investors said, this is just something that you cannot take at face value and say, got it, great, because there is no standard in how that is defined. Flipping to the next slide here, this was not a question for the survey, but it's definitely on everybody's mind, and I'm going to address a few questions here. So if I just, suddenly say, Randall opens up SaaScapital.ai, 10x plus, right out the gates? Nope. While we definitely hear a lot from investors and they're focusing very heavily on AI and AI native companies, that is not enough to have a ticket towards a premium valuation. You still need to ask yourself the questions that any strong, growing, durable business has. How does your AI use case differentiate from the market, or in this case, off-the-shelf tools? Many of you probably remember a lot of solutions coming out in 2021 where you probably said, isn't that just ChatGPT? And the answer was yes, and those got sniffed out by investors. Also, what is your data strategy? What is your competitive moat? As we know, these LLMs are trained off of oftentimes publicly available data, but do you have really unique data, really unique expertise that is making this AI proprietary to you and your business? Similarly, are you unlocking or creating new markets with your AI innovation, right? So many of these cases where we are seeing businesses scale to seemingly infinity, it's they're opening up new markets. And that is why investors are getting so excited to, oftentimes throw out double digit and in some extreme cases, triple digit multiples when it comes to these companies. And then finally, has AI driven outsized efficiencies, scaling benefit, and ultimately margin? I would say more so than the growth opportunity, what I see a lot of investors get really excited about is the ability for so many AI focused companies to scale with very limited headcount. And I think we all know the stories about, how some of these companies like Cursor, like OpenAI, have scaled and gone beyond, even 9 digits with double-digit employee counts in some cases. That is what's getting investors really excited. And to talk a little bit about the questions, right? Alexander asked, is it possible that the spread in valuation is partially attributed to the AI application layer and category leaders like Lovable, Cursor, and so on? These companies have reached 100 million in record times. And I mean, the answer, partially attributed, yes, absolutely. These opportunities to show very quick scaling is reframing what is possible when it comes to growth, and especially growth without massive, massive, massive burn behind it. I think there are opportunities out there, but however, I would say outside of those, category leaders, right? Investors still are sticking to these fundamentals, and oftentimes AI is becoming much more of a must-have, right? I'm not going to go to an investor in 2025 and bang the drum to say that we are a SaaS hosted application. I need a higher valuation for that. Of course, we're not on premise, right? And of course, in from the phase of 2005 to 2015, when we were transitioning from on-prem to SaaS, right? We saw a maturing of the view of valuation. You definitely saw in that 2010 to 2015 period on the charts Randall showed that ARR multiples started to creep up because people were realizing ARR can be pretty dang durable with high gross retention behind it. And on top of that, it can often be a better predictor of the long-term value of the business than the EBITDA at a point in time. But we still are, we're kind of in that right now in the shift from subscription to AI, where oftentimes having AI instead of a cloud hosted product is the expectation.
Yeah, just flipping back to show that slide in that come up period where the shift from on-prem to SaaS was still being understood. Are we going to undergo something like that with respect to AI? I think possibly, although this is a crystal ball for more of the equity folks, both
Yeah.
VC and the public market folks. I will say to the question from Alexander, just as a follow-on there, Alan, that is the spread partially attributable to these like huge numbers posted up and the huge growth rates at the AI leaders? Yes, but keep in mind the spread went both ways. The median stayed the same, the highs got higher and the lows got lower. So something is happening here where there's a disfavor being applied to companies that are still, again, if they're in the SaaS Capital Index, they're public, they IPO'd. Okay, so you're kind of in the Olympics, right? But the bronze medal is a lot lower than the gold medal. Let's put it that way.
Oh yeah, sure. I mean, all the questions I had here, you can flip it on its head for distressed valuations or untouchable assets, right? If you are a product where effectively you're based off public data, you are, performing functions that can be done now with LLMs. You are not in a new market and you're in a dying market. That's where you might start seeing valuations that are in the 1 to 2x range. It's not crazy these days that investors are walking away from targets because of the threat of horizontal tools in AI. And again, that's no different than any other time where there's been broad development, especially in horizontal tools. They can often challenge these vertical use cases. But if you do have a vertical use case with proprietary data, proprietary deep knowledge, think areas like medical, legal tech, education tech, right? Those are all areas that could be really, really valuable for AI, and investors see that. I think another thing too, thinking about some of the questions and this shift, Grant had a question here saying, how do you measure the valuation of AI companies? Can you comment on the trend towards consumption pricing and its impact on valuation? Yeah, so this is a great question, Grant, and I think you're going to get a lot of different answers from a lot of different investors because there isn't exactly a standard right now in how to view usage-based revenue. Many investors can view really durable, up and to the right, kind of like daily type usage revenue. They might view that as recurring like and ascribe similar, logic that they do to ARR, to valuation multiples. However, oftentimes people see a lot of variability there and give really big handicaps to usage. I would typically see it somewhere kind of between what you'd see for one-time revenue and recurring revenue as far as a valuation metric goes. But again, different investors view it quite differently. And personally, I view it differently from business to business, right? If you're, say, a payment processor for point of sale and you are just up and to the right with digital payments, right? That is pretty much the equivalent to a high NRR, ARR in my point of view. However, if you have highly variable revenue, if there are really high, call it, LLM token costs tied to that, you're going to need to, you're going to need to expect that you're not going to get a one-to-one with ARR there. So lots of variables, but I would say it's all about durability, predictability, and margin profile. If you can be as predictable as a 90% gross margin SaaS revenue stream, you're probably going to get pretty close to that valuation multiple on that revenue stream. However, if you cannot prove or articulate that, you should expect to see something closer to a services or perpetual license value ascribed to it.
Yeah, I think that's fair. I don't have much to add other than to say that probably a third of borrowers coming to us have some meaningful transactional or consumption-based revenue component beyond the usual sort of setup fees kind of thing, or occasional professional services. But my rule of thumb is generally if it's relatively stable and it's less than say 20%, if it's 80% committed subscription and 20% variable, then we can kind of treat it as more or less ARR like. The other thing I look at is the transaction or consumption revenue only coming from subscribed customers who I can otherwise treat as behaving like a subscription customer? Or do you have two different lines of business where you have this committed subscriptions and then you have the kind of, pay a nickel each time? Those are very different and they won't be valued the same.
That's a really good point. And I've often seen that with investors where they have businesses that are effectively two very different segments, different product lines, different revenue streams. You'll start to view the two parts independently, then smash them together to come up to your investment multiple. So maybe you're given 8x on this revenue stream and 4x on this, and the whole pie is 6.
I've seen that in equity land. The token pricing thing though, man, oh, wow. I mean, let's figure out what a token costs before we figure out how to price it. I mean, even the guys who are selling by token, the big model providers, it's not clear that their unit economics are anywhere near stable. So
no. And it's funny. I've been doing a lot of work here on usage revenue in particular, and a few things, that I've noticed specifically there on the token cost being anything but stable. Quick plug is we did some work earlier this year on pricing and billing trends and saw a lot of the usage-based pricing trends happening over the last 12 months. And one of the most fascinating things was understanding for businesses that are monetizing AI-based solutions, what's growing the quickest, right? Those that include AI-based features in the broader package fee because it's more of a focus on get pull through on net new logos. You've got that. You've also got those that are trying to come up with standard subscription or value-based pricing models tied to the AI. And then you've got those that are saying, you know what? I don't know what's happening. I got to protect my margin. I'm just going to go cost plus on what OpenAI or Claude or Anthropic is charging me. Shockingly, that last group are the ones that are growing the quickest right now. Yeah. And I mean, my theory behind that is that it's showing true partnership with customers to say, here are my costs. I'm working with this vendor. Let's mark that up for the value we're adding. But
maybe that's the kind of rosy view. There's another view, which is maybe that if Anthropic and OpenAI are subsidizing and selling the tokens at far less than cost, and you're buying and reselling it, what may still be less than the underlying cost, you're subsidizing your growth and your delivery. So I would just tread very lightly in that world, and it may be some time before we figure out where that lands. I would say you'd kind of harken back to the idea of a subscription model. We are, I wouldn't say we're rebranding, but I would say at SaaS Capital, software as a service has been the mantra for nearly 2 decades. But we are kind of starting to think of ourselves as subscription AI and software, because a majority of borrowers coming in today have significant AI components. And it's table stakes, right?
Yeah.
You're going to have, if not AI features, if not using AI in your development efforts and in your service delivery, you're going to be AI is going to be a core part of whatever subscription technology business solution you're providing.
Absolutely. And the other thing that I would add as well to those people that are thinking about how does this variable revenue impact my valuation multiple, keep in mind that usage-based pricing does not necessarily equate purely to usage revenue. And that might leave you scratching your head, but let me explain, right? Instead of having purely variable pricing that is month to month, oftentimes you'll find when you're dealing with larger customers, they want visibility. and they may be willing to pre-buy a inventory of sorts. And there are quite easy ways to structure that as a subscription with limits on number of widgets instead of number of seats. Kind of the same thing, and that number of widgets can change in the next year, just like the number of seats can. Suddenly, you're more of a predictable subscription revenue stream where you have the upside, opportunity with the growth, but also the downside potential in the future subscriptions. So it's definitely something that will be viewed with nuance, especially if it's a variable need. It might be lower quality subscription revenue, and different firms may view it different ways, but there are certainly mechanisms in place to leverage variable pricing models that have more of a subscription ARR based P&L.
Well, and having a tier based or package based approach like that, where up to a certain number of widgets in this tier, allows you to bill in advance as opposed to billing in arrears on actuals, which is also nice.
Absolutely. I'm going to get to this next slide here before we jump to some questions, because this one addressed a lot of the questions I had, here, and just best practices on managing those metrics, right? For GRR, the first question that I've had, pop up a lot here, how people are defining it. And as I've shared, right, a lot of investors are seeing churn and contraction, but you do need to understand how that disambiguation comes apart to drive action items to improve GRR. And some of the advice that I'd give for those of you trying to both track and drive improved results here to get improved valuations, number one is for GRR, it's not just putting coins into the customer's success slot machine as GRR goes up. You got to set targets, you need to scrutinize that investment, and you need to celebrate wins. Make sure that you're treating renewals just as importantly as you're treating net new opportunities. Celebrate big renewals, celebrate saves just as you would a big enterprise deal, and build a culture around gross retention and rewarding your team for achieving those gross retention metrics. Segmentation is also super, super, super important in understanding gross retention. Randall, and other investors are definitely going to be segmenting your customer base to understand where the risk is. And you should be doing that as well when running your business to figure out, where do I want to focus time and energy to drive this metric up? And then finally, I would also say track GRR regularly. It's something that I view on a monthly basis, oftentimes intra-month as well, to see how things are going to be looking in the following month. I'm not just looking at the full 12-month window of GRR, because if I'm looking at a 12-month look back, it's going to take a little bit of time to truly see trends. So, for example, I look at things at both a trailing 12-month and a trailing 3-month standpoint. Just looking at a singular month of retention is just too variable in some cases.
Mm-hmm.
But as I start to look at a trailing 3-month retention number, it helps me really understand how's the trend of my business going. For net retention, you're going to get a lot of benefit in net retention from everything you're doing, gross retention definitionally. But the one thing that I would say here that's super important about net retention is, and I've said this word before, disambiguate that full revenue snowball, right? Know what your starting balance is, know what your upsell, downsell, cross-sell, know what is truly just organic growth versus growth that you need to go drive through, cross-sell into the base. Because one thing that I'll call out with net retention, it is great to have net retention driven by cross-sell. It's even better to have net retention driven just by organic seat and usage growth, right? So make sure that you know the levers in net retention and how you can impact it before you start highlighting this as a metric of the business to truly understand the long-term viability. The other thing with net retention, saturation is real. Be honest about your, the white space opportunity you have ahead of you and the ability to capture it, and make sure that you're constantly viewing that and saying, how can we continue to drive more sales into the base if you truly believe that you are a high net retention type business. Not all businesses are made to be high net retention. It doesn't always make sense to have revenue scale up and to the right for every customer that buys into infinity, but there is often a lot of opportunity to continue to sell and organically grow these accounts. And then finally, with LTV to CAC, as you guys saw, there's no magic number to back into. However, you should have a good understanding, especially each year in your budgeting cycle, what that metric tracks to. And if it seems, if the ratios are far off, right, understand the why. Understand what is holding you back from a profitability standpoint. Understand what is holding you back from a distribution efficiency standpoint. And ultimately, make sure you have a good pathway to show how you're going to get strong EBITDA margins. You could potentially get away with, a worse metric on LTV to CAC if you have a clear pathway to 20, 30, 40% margin. But if you're having margin pressure and you have the problem with CAC, then you might have a little bit of an issue of proving out how can I be a long-term durable business. I'll pause there. Randall, I'm not sure if you have any other input on these metrics and how you view them as an investor, but I
The
can.
only thing I do is, and living in Excel as I do, I'm going to click and drag segmentation across all three columns. Okay.
Great.
Because just as you're doing it in gross and trying to find the leaky bucket there, it's important to figure out in net revenue retention, are you doing great upsells in that, in a leaky segment, and maybe it's covering up the leak or what have you. So I would do that across the board. And hopefully that helps with defining ICP and focusing in and getting away from what companies in my universe, in that sort of 3 to 10 million range. It's very common that you kind of fire a segment or a vertical and you
Yeah,
find a new ICP and pivot to it. So knowing what that's going to
100%.
be and focusing is going to be what, for the 12 to 18 month plan theme of the title here, is going to, allow you to drive towards those in the sort of short to medium term.
Absolutely. Know your ARR inside and out, track it regularly, segment it every which way. Make sure you have the tools and reporting in place to view this on a regular basis and truly understand how these metrics are calculated and the underlying data. Because I guarantee you, when you start going into either a fundraise or an acquisition opportunity, you're going to be asked these questions very, very often by investors. Just jumping to questions here, and we had a few here around profitability in particular, and I'll ask you this, Randall. It's like, have you looked at how profitability margins like EBITDA are currently affecting valuations? And similarly, like, how do you think about Rule of 40 performance with private companies being correlated to these valuation multiples that we're seeing on the public market?
At the beginning, you said rule of 40 or even 50, Alan. And I would say that I don't see rule of 50 companies. I think that that's a privilege of folks who are seeing kind of the mezzanine pre-IPO later stage folks, or the very tip top of maybe what's happening in Sandhill conference rooms. Those would be phenomenal numbers at any scale to hit rule of 50, I think. Growth has been challenged. It's been much more challenged in the last 12 to 18 months than it has been prior to that. So I've seen the pendulum has swung. It's still in the zone of people really being more concerned about profitability and runway. Rule of zero is definitely a starting place. Okay. So if you're not outpacing your net income loss with your growth rate, that would be sort of a flag for sure. Getting that number to rule of 40, fantastic. I liken it to, that's getting into the Olympics, right? And now you're competing in the very big leagues. But I think that, that number needs to be positive. And if for any reason it's not, it's very unlikely to be associated with a valuation that anyone's going to want to transact at.
Of course, that makes a ton of sense. Another question here that I'll take, and it's a couple specifically around GRR, NRR. David asked, what if a company has consistent GRR above 95% and loses one large client that got acquired and GRR moves to 90%? Is that just an unlucky event? Similarly, I had a Jeff M ask about regarding NRR. What about macroeconomics? If companies were hit by macroeconomic factors that still have to be calculated, do you handicap the evaluation because of it? Do you look at it on, in relation to the broader market? The first question about GRR, right? And again, this gets back to Randall copying and pasting segmentation all over the world. That's exactly the answer here as well, right? What I would strongly suggest in a case like that is make sure to, position your business both with and without that anomaly, and ensure that, if you truly believe that you are a 95% retention business and you truly can prove out that this was a one-time event, you can get investors to start looking at your business X that one company, right? So instead of applying a valuation multiple based on 90% GRR to the broader pie, maybe they'll look at 95% with the slice of the pie that does not have that large customer.
Yeah,
And
related to this Trish's question about, do investors look at just the numbers or also the reasons and drivers of churn? And look, I mean, one-off things do happen. It's why, as lenders, we are kind of allergic to big customer concentration. customer is half your revenue, then half your revenue is at risk with a meteor strike or a crazy lightning strike. If it does happen and it's 5% of your revenue goes away, as David mentions, and it kind of dings your gross retention, I think folks who would have liked the business the day before the churn are probably going to like the business the day after, if you can help them understand that it really was a one-off, a lightning strike, as opposed to, hey, this is the beginning of a trend. So be prepared to explain it, be prepared to do those numbers pro forma X the missing customer.
Exactly. And I think what I would say as well to, both the question around churn reasons, also the question around NRR and macroeconomic, the most important thing for you is to truly understand the disambiguation of that snowball and know the why, right? Because you need to know the why in order to impact change within your business. And investors need to be able to see that you can impact change in order to assume and underwrite to some of these metrics improving.
But that
So,
does not scale, by the way. Having a Y for the 12 churns over the last quarter, like that's a different story.
Yeah, I mean, you need to know why, but there are good whys and bad whys.
Right.
I think I probably have time for just one more question here. And the last one I see here, and again from David, is about premium valuation. Assuming top GRNRR, assuming rule of 40 and 50, how does TAM play into the equation for a vertical software business? It's really important, right? It becomes a mathematical question of saturation and what is the actual terminal growth potential of this business, right? If there's no way to truly show that you're going to make a profit on the business through a DCF model, investors are not going to be excited. And if there's a ceiling on how much you can grow, you better believe there's a ceiling on how much valuation you can get in the market as well.
I think those super valuations, the ones that are up and above the 95th percentile that are driving that skew, are ones where the potential TAM is at least seen as enormous. Society changing, right?
Yeah. All right. Well, thank you so much, everybody. It was great to have you all here. Please check out Randall and SaaS Capital for all your lending needs, as well as the index, which is providing a ton of great information. I'm checking that out every year. And then similarly, check out Maxio for your reporting, billing, and RevRec needs. We can help you get a better handle on ARR. We can help you get a better handle on those metrics. And ideally, we can help you get a better valuation. So thanks, everybody. Thank you, Randall. It was a pleasure having you.
Thanks, Alan. Pleasure was mine. Take care.